Most entrepreneurs think they understand their numbers, revenue, profit, cash flow. But the reality is many businesses fail not because they don't grow, but because they don't understand what their numbers are actually telling them. My guest today has spent decades on both sides of that equation, as an investor, as a CFO, and now as an entrepreneur helping companies turn financial data into strategy. Welcome, or hopefully welcome back to The Reluctant Entrepreneur. My guest today is Salvatore Tirabassi, Managing Director of CFO Pro+Analytics. Sal brings over 25 years of experience across venture capital, private equity, and executive financial leadership. He's raised over $400 million in capital, participated in multiple acquisitions, and now works as a fractional CFO, helping companies scale through better financial strategy and analytics. He's raised over $400 million in capital, participated in multiple acquisitions, and now works as a fractional CFO, helping companies scale through better financial strategy and analytics. We'll dig into Sal's journey and find out what better financial strategy and analytics mean when I return in just a moment. Stick around. Hi, Salvatore. Welcome to the program. I'm excited to have this conversation.
Yeah, me too. That's an awesome intro, by the way. It's very well done.
Oh, thank you very much. Well, it's easy to produce awesome intros when there's an awesome guest. So it makes it a lot easier.
Okay. I wasn't asking for that, but I'll take it.
Well, I'm going to throw that right back at you. You deserve it. So, Salvatore, you've had a career that most entrepreneurs never actually experience, from consulting to venture capital to CFO leadership. It's quite vast. What originally drew you into the world of finance and investing? How did you get into that crazy part of the world?
Yeah, so when I graduated from college, I wanted to be in consulting because I just felt like it was a way to learn about a lot of different businesses from an operating standpoint. Now, there's pluses and minuses to that in terms of like what kind of exposure you get, and there's always like the big kind of bugaboo in the room with consultants that they hand you a presentation and it's not something you can operationalize, or it's just people doing typical CYA work to make sure that they've covered all their bases. But regardless, it was a really good avenue for me to look at a lot of different businesses and understand how they operated, just kind of as like a young person, just being curious. But at the time, that was kind of like the late 90s, mid to late 90s. Venture capital was really becoming kind of, I would say, like the early stages of its maturity was happening. I mean, it's far more of a mature industry now. But in 1997, we were kind of like progressing into the internet bubble. A lot of venture capital activity was happening, and the market was kind of opening up. And I was really intrigued at the opportunity to go into seeing, how to build early stage companies. And so I went from management consultant into venture capital, and then hit the internet crash like 9 months after, or 6 months after I joined the venture capital firm. And so I immediately went into kind of like restructuring mode, recapitalizations. A lot of investors were just like scattering for the hills at that time. But that's how I got into finance.
You know, when you consult with your clients, I have a definition of a consultant, and it's going to sound like a dig, but it's truly not a dig. And so bear with me on this one. My definition of a consultant is someone you hire to tell you what time it is. And the first thing they do is ask if they can borrow your watch, meaning that the answers are right there in plain sight. They just can't see them, right? You're not, they don't pay you to change the numbers, right? But as a CFO, and I've worked with CFOs in the past, we also, at my company, we have a fractional CFO. Sometimes they show us what we, well, not sometimes, regularly, they show us what we just can't see or don't see or don't want to see. Sometimes they're filled with inconvenient truths that are painful. Sometimes they
Right.
bring relief. It's all of that. But, if you can't see it, you can't fix it. And the first CFO I worked with had a saying when he would say all these like scary things that were going on with our company way back in the day. He would say, well, that's good news because we can't fix it if we can't see it. First thing we have to do is see it. Does that ring true in your world?
Yeah. All the time. All the time. I mean, being able to see it is the part of the work that a really good CFO needs to know how to operationalize and do very quickly. Sometimes it's triage level work. Sometimes it has to be really in-depth analysis. And then the really good CFOs take that information and they turn it into like a repeatable process that doesn't take a lot of effort to continue to monitor. And then you basically, now you're saying, hey, they didn't just borrow my watch, but they gave me like a brand new clock for me to put on my wall. And
Right.
now we can look at it whenever we want. And then the next time the next issue comes up, there's another clock that goes on the wall. It's like, oh, I can see Eastern time zone, mid Central time zone, Mountain time zone, Pacific time zone. You get all these clocks on the wall, and they tell you a lot about what you need to see and pay attention to. And that's what really, really good CFOs are able to do from an operational standpoint. There's a whole other set of skills related to raising capital, storytelling around the business, but fundamentally, those aspects of being a good CFO are are driven by the clocks on the wall. If you've got the clocks on the wall and they're all telling time correctly, raising capital, telling the story, um, inviting people in to take a look at your numbers, that all gets way easier to do.
Well, kudos for successfully expanding on my corny analogy. You did good with
Yeah.
that.
I
so,
love metaphors, by the way.
so
So
do I.
they're a
My,
great
my
way to,
friends and family make fun of me because I have an analogy or a metaphor for everything. You
yeah.
spent about 15 years in venture capital and private equity. What did you learn during that time about what separates successful companies from those that struggle?
Yeah. Actually, before I answer that question, can I tell you about a funny metaphor that one of my analysts once left in big letters on a whiteboard?
Of course.
And it was if you're a paratrooper and you're parachuting down at like, I don't know, I don't even know where parachuters parachute down from, but let's say you're parachuting down from like 30,000 feet and you look down and you see that there's a giant hole in the ground from 30,000 feet, there's a problem,
Yeah. If you can see that from
right?
30,000 feet, yeah.
If you can see that from 30,000 feet, there's a problem. So the reason I had that metaphor was like you could be pulling data at a certain level that's very abstracted, but if you're pulling the right data and you're looking at it correctly, you can see that giant hole in the ground that's 30,000 feet away, and you
Right.
don't need to know a whole lot more to know that I better start figuring out why that's there because it's a problem. Anyway, that's
Yeah, it's better
my
to see the hole from
token metaphor.
30,000 feet than from the point of entrance into the hole, right?
Impact.
Because then you
So
can't,
yeah.
there's not much you can do about it. So tell me about your 15 years in venture capital and private equity and and what your experience is, what separates successful companies from those that struggle.
So in a nutshell, the one thing I will say is one of my uh, uh, one of the managing partners at one of the funds that I worked with, who's a pretty prolific, accomplished investor in growth equity and venture capital. He once posed a question, kind of a rhetorical question, to a few of us while we were having lunch, and it was, "What would you rather have, an A team of managers with a business that is kind of has a mediocre or unknown wind blowing into its sails? Or would you rather have a B team with the wind blowing, I don't know how many knots of speed into the sails of this? Here's another metaphor for you, right? But
Yeah.
he actually was a sailor. So
There you go.
blowing wind into its sails. And not an easy question to answer, but he had been around for a long time and was very successful. And his answer was, as much as I love great management teams, having the wind at your back in a very strong way allows less effective management teams
Hmm.
to mask their errors,
Yeah.
and they can succeed in spite of the fact that they're not as good as the other team. Now, granted, if you have the A team and the win, that's the ideal scenario. But so my answer is that picking the right uh, you know trajectory of an industry is super important, especially earlier stage. Obviously, the earlier you go, the harder it is to like figure out what's going to be the winning strategy. And so it becomes a little bit more of like a lottery ticket, which the great venture firms are really good at narrowing that down and figuring out who's going to win. But for the average person, it's much harder to pick, which sailboat's going to sail the fastest to the destination. And so I think that in my preference is, when you're looking at is to look at businesses that have a little bit more maturity to them and figuring out where the A team is and doing less guessing about which direction the wind's blowing. And so the team and the quality of the team and the ability for them to manage, take feedback, um, have an appreciation for the things that they don't know, and may never find out. Those are the types of people that get much further along.
You bring up a really good
You
point.
know, it,
There were times in my business where we were doing well in spite of ourselves. We thought in the moment it was because of ourselves. And, we thought we had the magic formula. All we have to do is go in, wave a wand, say the magic words, and good things happen because they always had. And it turned out at some point, the circumstances in this, continuing the metaphor, the wind at our back is what was propelling us, not what we were doing on the boat. And when the wind died down, that's when we realized, oh my gosh, this is not us. We probably were slowing it down, if anything else, right?
right.
And sometimes, all the time actually, as Jim Collins, the author Jim Collins stated, the enemy of great is good. And if you're doing good, then maybe the economic conditions are good. Maybe the wind is at your back, so to speak. But as soon as those conditions change, then you realize you're really not doing good. You're actually doing poorly. And
Right.
what you thought was your propeller is actually your anchor. And that hit us one day very quickly, and we realized that, we thought we were all that in a bag of chips, and it turned out we're none of it. And we really had to start getting good at what we do and strive for great. At what point did you realize that you wanted to move from investor and executive into building something on your own? That's quite a transition.
I just had this thought in my mind for like the next phase of, you know, just personal growth and professional growth. That I had been around a lot of boardrooms, executive teams, and I just wanted to kind of do something on my own that could bear a lot of fruit quickly and be pretty pretty satisfying service for my team to deliver, but also could add a lot of value to the people that we serve. And packaging my CFO capabilities into, a high quality service that's delivered with consistency and with real, execution deliverables could add a lot of value to lower middle market family founder owned businesses that normally, would never really talk to or be able to have access to the kinds of people that I have on the team.
Hmm.
They're more on the finance side are probably more fishing around ponds of, traditional sort of like accounting people that are closing their books but not giving them the strategic financial approach. And my view is that that's like one continuum. And I feel like a great finance person is always going to be able to handle the accounting, um, and the strategy, but uh, you know the base level of accounting where you're looking backwards and trying to follow the rules of explaining how things happened doesn't necessarily translate into what's going to happen next. And so as a result, we have these teams that show up to the companies and they make, a huge difference, pretty much from day one in terms of how the owners can start thinking about their business. And so I thought that would be a really fun thing to work on. I like having a team and a service that delivers the goods consistently and gives these owners who have so much skin in the game in these companies, most of our clients have not raised outside capital, gives them the ability to really think more freely about their business and understand the nuances. It's pretty empowering.
One of the things that
Uh,
you said kind of stuck out with me. One of the several motivations to start a business, as you stated, was maybe to give people who wouldn't normally have access to the type of knowledge and the type of skill that you can bring to the table. Because in your past life, those weren't the clients you were working with. You were working with much larger clients. That has all the markings of a purpose-driven business beyond just making money and building a business. It sounds like you also had a motivation to do something good to those who might not otherwise be able to access that type of advice and services. Did you think about that at the time? Did that strike you at the time, or was that just how it
it
worked out?
struck me, yeah, no, it wasn't quite as explicit as that. Uh, but it struck me very early on once I started meeting clients that were like one relationship removed from like my immediate network ecosystem who already knew me and were kind of coming to me because they knew the level of expertise that I could bring. But once I got outside that immediate circle, which was like within, honestly, kind of crazy, within like 90 days of starting the business, and I was talking to like now one step removed, and I could show up to like a consumer packaged goods company, which I had never done before. And at this point, I have like one person on my team, and I'm talking to this CEO, and I'm realizing like, oh, this guy needs an asset backed loan on his receivables, and he knows mechanically that he needs it, but he doesn't really understand like how he's going to convince people to lend money on his receivables. And I had done receivables loans in a completely different industry that had nothing to do with like building and selling products to consumers, but I knew the mechanics, how it worked.
Sure.
And I realized, wow, we could just instantly add value to these, really, hardworking entrepreneurs who have all these other things that they're worried about, and all of a sudden we show up with a canned set of knowledge that we can put to work pretty much immediately. I mean, so it quickly became, uh, you know, purpose driven's a good way of explaining it. It's not kind of how I thought of it. It was more like adding critical value to people that really deserve to just have the information and the capability available to them. You know,
Now, you had a lot of experience. You're a little bit of a unicorn in that most entrepreneurs start a business and they know all about the core side of their business, the product they're selling, the service they're providing, whatever the case may be. But many entrepreneurs don't know much about business. You, when I say you were kind of a unicorn, you were exposed to all sorts of business types
yeah.
and worked with business leaders and obviously knew accounting and finance and all that stuff. So you had a pretty good view. But when you started your own business, was there anything that was harder than you expected? Maybe something that you didn't pick up along the way that just became your new reality?
Um, I would say the two things that were uh, I knew they were a part of the formula, and they vary in kind of the challenge. Uh, One was, which I'm still working on and testing things on, is just arm's length customer acquisition. Like, these are people that don't know me, need to build trust, don't know my firm. Um, and figuring out, like, what are the methodologies for doing that. I had done and had been involved strategically from a data science standpoint and from a financial standpoint in a lot of direct customer acquisition models, digital, direct mail, webinars, that kind of stuff. But just figuring out how it was going to apply here, that's still an issue. That's still something that I'm trying to figure out. And I probably kind of annoy some of the vendors who come to me because I test a lot of stuff, and so I have a lot of answers before they even try to get a meeting with me, and I turn a lot of people away because I'm like, I already tried that. But that's one area. The other area is just filling my bench with good talent. Um, and I haven't had any major misfires since I started. I had one person that I ended up replacing on a project, and it wasn't a competence issue with the person that I had. It was not a good fit with the client, who really needed to be corralled in terms of priorities, and the person that I had on it was just not effective in getting the management team to rein themselves in and really come up with like a strict set of deliverables that they were looking for. But finding the people who can navigate that, because you do have to have the ability to guide clients on what they want to focus on. That's part of the CFO's job. And it's a delicate balance where don't you don't want to be the no person. You want to be sort of the positive voice of reason, and finding people who can do that and then also do the work is a bit of a challenge. I go to, when I'm out networking, I'm hoping to meet people who can introduce me to clients mainly, and also talent that can join the team. The good
How did you?
news is that I grow in discrete increments, so keeping the bench in balance with the company growth has so far been relatively easy to do. But if I catch lightning in a bottle with a bunch of new clients, I'm going to scramble a little bit to figure out how I fill those seats.
Sure. How did you get your first clients? What was it, through networking, people you already knew through networking, or working with directly, outbound efforts?
They
Where
were they were people that knew me. They heard that I was out and available. They knew what I was capable of, and they just reached out and said, "Hey, we need help. What can you do for us?"
Right.
And then after that, it was once I got kind of the flywheel spinning and I was in the process of building more of an authoritative voice in the category. I had, I would say, like second and third level connections. If you're thinking of it from like a LinkedIn standpoint, not that that's how I
Right.
get my clients, but
Right.
then that started coming into the funnel.
For someone listening or watching who hears the term fractional CFO, I'm throwing that term around as if every one of my viewers or listeners might already know what that means. What does that actually mean in practical terms?
The way I would explain it best is we have the skills and capabilities to deliver you all of the meat and no fat in terms of cost for our services. And that means that you're getting on a permanent part-time basis a team member that, or team members that in the aggregate cost you way less than you would have to pay if you hired everybody full time. And we still deliver the same level of service that you need, but also with like a level of expertise that exceeds what, a one lane CFO might do for you, because our people get the benefit of the whole team and the variety of clients that they work with, and they're also their experience from the past. So they and the kinds of issues that we deal with are action packed issues. You decide one day that, or we come in and we decide that your ERP is not going to work. Well, we'll figure out a way to like bandage that, or very reluctantly, because we don't like to do replacements. We like to have high impact quickly. We'll replace it if you need it, or you may hire a CFO who's never done an ERP replacement and feels like he or she needs like two other people to go do that for them. Whereas on our team, they eat that for breakfast, and if they need to bring in an extra resource to do it, it's going to be a resource that's going to come in on a part-time basis. You're not going to have to hire them. And they're people that are not working for the vendors. And we know what the end result's supposed to look like from an operational standpoint,
Right.
right? So you get all these advantages, and it's all delivered on a part-time basis. Typically, the service stack that we deliver is 40 to 60% of the full-time cost of super high quality people. I mean, MBAs from top business schools. These are people late career who want variety, access to the decision makers, and control over their schedules. So it
Yeah.
makes it really attractive for them as accomplished professionals to come in and start delivering the service in a completely different tier of the market that they may not have been working in before.
What would be in basic principle terms, what would be the difference between a bookkeeper, an accountant, a CPA, and then a CFO? I can just
Good ones
hear
or
in my head. Well, yeah, all assuming they're all good. Okay, they're all
good?
the best at what they do within those defined job descriptions or titles. I can just hear some of my audience in their heads saying, "We've got a great bookkeeper, Sally or Fred or whatever. She's great. What do we need
Yeah.
a CFO for?" Or we have a relationship with a CPA. They do our taxes every year. What functionally would be something a CFO would generally be involved in that down the ladder, CPAs, accountants, bookkeepers would, generally speaking, not have a clue about?
Um, I was thinking when you first asked the question, I was thinking, should I start from the bottom and go up? But I'm going to go right to the CFO. So,
There you go.
um, uh, you have a sales team of 20 people. and you're trying to figure out the booking profile of sales across the 20 to see if you can gain an understanding of why the top 20% perform so much better than the bottom 80%, which is pretty typical in good sales teams.
Yeah.
And also, is it related to externalities, like who their team managers are, when they started, what industries did they come from? Versus also what's happening internally is like, do you have a lead distribution issue? Do they spend too much time, you know, uh, building their funnel? Um, uh, a bookkeeper is not going to do that strategic analysis for you and give you the answers, so that you can go and then modify how you're doing your recruiting, retention, and compensation for that team. That's a CFO's job in a mid-sized business. Um, sure, you can hand it off to potentially an analyst that you have too. That might be a way of doing it. But at the CFO level, they're really going to be thinking about depth of issues on quality of customers that they're bringing in, longevity of the customers that they're bringing in. These are higher level issues that need a 360-degree view, and also the ability to communicate it to the constituents. A bookkeeper is not going to do that for you. They could tell you like why. They could tell you how much the top 20% salespeople are getting compensated and how many deals they brought in relative to the bottom 80%. But they're not necessarily going to give you an analysis to like really help you define like what makes the top 20% successful and how do we get more of that. That would be a pretty, you know, basic example. Another one might be, um, if you're looking at working capital financing, how do I balance the cost of the offers that we have in terms of interest rate versus the amount of liquidity that they give us?
Right.
Right? A lot of people might get loan offers for working capital and they'll say, "Oh, this guy's cheaper because he's pricing a loan at, prime plus 2%, and this other guy's pricing it at SOFR plus
Hmm.
1,000 basis points. So that guy's in like the 14% range, and this guy's more in like the 9% range." And then they don't really take all the other terms into account that are in that term sheet and map them into a forecast to really understand like, well, which one is going to give me the most money,
Right. For the least cost
um, for the least cost.
and the
And
most
it may be
favorable
that the guy,
terms. Right.
yeah, and it may be the guy who's charging you 14% totally demolishes the lower price competition because he can give you, on his terms, he can give you $10 million of working capital, and the other guys are going to cap you out at 5.
Sure.
And 10 is what you need.
And the
And when you
covenants
do
may
the
be a
math,
lot friendlier too, right? The covenants
you
may be
might
a
be
lot friendlier.
friendlier
A lot of
too.
people don't
Yeah,
realize, they don't read the covenants. They look at the interest rate and the amount, and they don't realize, annually there's a 100% pay down requirement for 30 days, and
right.
all of that stuff that kind of is gotcha, later.
Yeah,
There's a
yeah.
lot to it.
I have uh, a current example of a client who's in the working capital market right now, looking to get financing. And the reason that they're there is that they had a really good lender that we chose at the time. They were great to work with. They had good terms. They were competitive. And what happened to this client is, I'm not going to name names, but one of their customers is a large US retailer, very well known retailer, who became, who just grew very quickly. They loved the product and were just pushing it through all their stores. The lender caps the amount of liquidity for that set of receivables
As a
at
concentration?
four because of concentration at
Yeah.
40%.
Yeah.
It's an A grade credit.
Yeah.
And the owners of the business and ourselves are kind of like, hey, look, it's a great credit, and this is driving the growth of the business. And they're kind of like, hey, that's our credit model. We can't overextend. And so as a result of that, you end up with like this drying up of liquidity in the business.
As they're
And
growing,
it turns
which is a
out
death
as you're
sentence.
growing,
Yeah.
as you're growing. So the answer is in this case is we found alternatives who don't have concentration limits. They're more expensive, but the liquidity is dramatically different.
Right.
And at that point, I don't want to say the price doesn't matter because it does, but the level of liquidity at the price that these competitors are offering has very little impact on the decision about trading out.
Yeah.
It's like a totally different ball game that you're in.
Sure. You've stated that financial data should drive decision making, which, completely agree with. What are most companies missing when they look at their numbers?
I mean, it's different for every client.
In general terms.
I think the big thing that I find is pretty common is some sophisticated precision on customer value, which if you go up the funnel, you can say it's customer acquisition costs. If you go a little further down the funnel, it's the unit economics that each customer provides, and it comes in a variety of different forms. But one of the things that you know I find is there's some clients who don't see the total cost of servicing the client, and they also sell these one-off variants of what they do that's not repeatable, and they feel good about it when they close the quarter. But then that client who needed the exceptions really is a challenging client. And you can't replicate that offering to other people because they're not exactly in the ideal customer profile. And you've got time and bandwidth and attention and overhead costs going into servicing that client. And it's really like degrading the profitability of that client. And it's a little bit of it is looking at the data, and then a little bit of it is interpreting like why are these guys the round peg in a square hole, um uh for this offering that we have. And um and it's that continuum of like customer acquisition to client value that really um is something that we see people really need a better understanding of, particularly like the more sophisticated that they are, and
Yeah.
the more mature the business is. I think at the beginning you're always trying to figure that stuff out, and we generally have clients who've already kind of figured out their ideal customer profile, the ICP. But once you get the flywheel turning and you're bringing in more clients, you want to keep saying yes and keep growing, but sometimes those yeses end up hurting you later on.
Yeah. I say this almost as a joke, but there's a lot of truth behind it. I think I've made more money saying no than yes over the years because a lot of my
Yeah.
yeses were tragically terrible yeses. To the wrong customers, to the wrong prices, to a lot of decisions were bad, and sometimes, frequently, the word no is way more profitable than the word yes. I think a lot of young in experience business owners are so desperate to make their mark and start getting revenue in. They say yes to a lot of deals that
Yeah.
probably checked a box in the moment. I've talked on this show a lot about our early days. We have payroll every week, and every Thursday. And Wednesdays were always sleepless nights for me, right? It's like, is everything going to cash? Are we going to be able to cover it? So I'd spend most of the from Friday to the following Wednesday raising money, getting deals with down payments at in exchange for a huge discount, just to make
Discounts,
sure
yeah.
I could cover payroll. And well, Mike, what about profit? That's not my problem today. I'll worry about that at the end of the month, or the end of the quarter, or the end of the year. Right now, I just need cash to cover payroll or whatever expenses were blaring at the time. At what stage, and I know this is probably going to be hard to pin down, but generally speaking, at what stage, and that could be revenue wise or other factors, does a company really truly need a CFO over an accountant, a CPA, a bookkeeper? At what point does it really make sense to, economically, whether it's fractional or full time, to bring in the talent of a CFO? Is there a is there a
Um,
particular threshold where it's like, okay, guys, yeah, time now?
yeah, I think once you get to 2 to 3 million of revenue, you should be paying for some strategic financial advice that uh you know on an hourly basis is seems like you're spending a lot of money, but you want to have that type of thought partner in your critical meetings, helping you set up a cadence of meetings, helping you streamline your reporting, getting your bookkeeping on point. We walk into most situations where the bookkeeping is really subpar, um, and you know, it needs to be remediated basically. So, I mean, we had one client that we walked into. Their cash was tying out. Their profits looked right to them. It turned out though that the ERP that they were using had this weird glitch in it where it was booking sales and cost of goods twice, once departmentally and then once like in the consolidation. So they were canceling each other out. So their gross margin percentages were completely wrong, but their cash flow and profit was right. And it's kind of like, who's even looking at this stuff? You should just
Right.
know from your sales orders that it's impossible to do this amount of revenue. I mean, that's an extreme example. Now, granted, if the cash was wrong, they would have figured it out right away. But
Sure.
because they've been operating for like 10 years on this platform and no one ever thought of, and the bookkeeper never connected the dots on it, so
Yeah, the profit or
s-
loss was right, but the margins were, from a percentage standpoint, were
we're
all
raw.
wrong.
Right,
Yeah,
right, right.
interesting.
And there was no one, if you're running a cash flow business and you're just looking at what's in the bank account at the end of the month, yeah, you might, as the owner, may not ever think about how you got there. You sort of do rough math in your head and you're like, oh, yeah, I closed this many deals. It's usually about this amount of profit. Yeah, that sounds about right. And you just kind of keep rolling along. But if you had to present those numbers to a third party, they would be like, "Oh, can I trust anything that's coming out of this company?" They got an ERP that's like double booking revenues and expenses. But that's like a tactical issue. Um, what I'm talking about more is like feather in the strategic part of it that also includes supervisory initiatives over the accounting and leading into some forecasting and more sophisticated reporting. Bring that in and make that part of your normal cadence early on. And these days, a lot of people are like, "Oh, well, I'm just going to use AI for that," and I'm like, "Sure, you could definitely try to do that, but AI has no understanding of the the core competencies of the company and the decisions that you need to make on a normative basis, like qualitatively, like adding salespeople, financial decisions that affect culture, what your
Right.
mission is that you're trying.
Right.
It's can maybe streamline some of the data for you. It's better to put that in the hands of an expert who knows 10 times more than you know and should even worry about as an owner or as the CEO, who's leveraging that to its maximum capability to do even more for you.
Is there a place today for AI in the financial operation of a company?
So I'm at the stage where I have a database of about 24 different vendors that are pitching some version of the financial brains
Yeah.
of the company. And I probably took demos of 10 of them, and none of them to 100% enable the CFO function to the level that I want. They focus on different things that they perceive as like the main problems and
Mm-hmm.
bottlenecks. And some of them are compelling for sure, and they definitely would make us way more efficient and effective in what we do. So I think it's it's going to happen, and then the interpretation and the level of expertise to enable those technologies in the right way is going to be what our role is going to be. And then it makes us even more effective. Right now, just personally, I'm just a huge fan of Anthropic's Claude in Excel. We're a pretty Excel driven shop. We have a couple of clients that we do a few things in Google Sheets for, but if you're doing like sophisticated modeling and analysis and dashboarding and connecting and mashing up a lot of data, I just find that the Excel environment works better, and Claude in Excel as an add-in is a great tool. We use it all the time.
I don't know where they came up with the name Claude. I could think of 1,000 better names than Claude. Um,
I
I don't
don't
know.
know.
I don't know. Henry, Frank, Janet, but Claude. Maybe they wanted a name that isn't all that common. I don't know.
It could even have been just like, is there a name we without question can trademark?
Right. Maybe
Could
it's
have
good
been
for
just,
SEO and trademark and all
yeah,
that
could
stuff.
just be
Yeah,
totally mercenary.
totally could be. You've helped companies raise capital quite a bit. What are the biggest mistakes founders make when preparing for that process?
Oh, I would say they underestimate the need for a competitive process. Entrepreneur uh, gets a friend of a friend over the transom who's running a much bigger company or some funding source outfit, and says, "Hey, oh yeah, I can handle that for you," or "Yeah, I'm going to acquire your company. Let's go out to dinner. Send me some due diligence information," and then they hand them a set of terms, and they're like, "Oh, well, this doesn't make sense for me," um, and uh, as a business, when you're raising capital, it's the first time that you're doing something extremely valuable to the business and to yourself, potentially personally as an owner or entrepreneur, where the competition is reversed. Yeah, you can say, I don't know, I'm gonna uh, negotiate with HubSpot and Attio to get the best CRM price and tell them that there's competition. That's not going to make you millions of dollars, right? But when you're raising capital or you're selling the business, that is potentially going to make you millions of dollars. And that's not as simple as going online and or going to like chat GPT and saying, tell me the top 5 CRMs for you know, I don't know, a SaaS healthcare business or something like that. This is like, you got to get in front of people, you need to impress them, and the guy who comes over the transom is like marrying the first girl you date. And chances are when they give you that term sheet, you're going to be like, I don't like this. And then you realize like, well, I need more term sheets.
Right.
You don't only need more term sheets, you need competition. And that's where they kind of make the mistake. And I think some entrepreneurs get choke on the cost of generating the competition, because a great financial team inside your business combined with a broker a great investment banker outside your business is going to more than pay for itself in driving up the value if they can generate the right competition. But they look at the percentage and they're like, oh, I need to raise, $3 million of equity, and this guy's going to charge me 8% to do it. That's just too much money. I don't want to pay that money. And it's like, well, you got to respect their time. If he raises the $8 million, all he's making is like $240,000 on that capital raise. But if he brought you 6 term sheets and you can pick the best one,
right?
I mean, what there's really not a whole lot to complain about. So it's that mentality, it's like, you got to think big to be big. But also you want to pick the right investment bank. You don't want to pick somebody who's not going to be effective. And by the way, if you're raising capital and you talk to a lot of bankers and none of them want the deal, that tells you a lot too.
It sure does. Yeah. Yeah. They're seeing something that you're not seeing, clearly.
That you're not. And they're always going to tell you very nicely that they're selling. They are never going to tell you that your baby's ugly.
Yeah. As ugly
It's
as
never
it
going
might
to
be.
happen.
Right. Right.
It's never going to happen. And the way you're going to know that is when you talk to 3 of them and they all take a pass.
Right.
Then you need to kind of do some introspection and maybe even get them on the call and say, hey, look,
give permission.
We bid this thing out. Just tell me, like, what do I need to fix? Like, what's wrong here?
How ugly is my baby? Yeah. What are the key metrics every business owner should understand, regardless of industry?
Definitely customer acquisition cost. What does it take for you to bring a closed deal into the funnel? I'm just going to do like point answers, because there's a lot behind that also. But you want to know the value of your customers over time. How much true gross margin and net margin do they produce? And the net margin is the tricky part, because you need to like be honest with yourself about which of your clients need more time and attention than the ones that are just set it and forget it. You want to really understand your cash in and out. Ideally, have a good sense of it on a weekly basis if you can, especially if you're in a smaller business. Although I can make an argument that, you could do this at like whatever size. I think, I don't know if the audience might be aware of this, but when the credit crisis happened in 2008, I was stunned when I read in the news that General Motors on any given day didn't know where, like, I want to say it was like $5 billion of cash was.
Yeah. How do you lose $5 billion? I don't mean lose like profit loss. I'm talking about just misplacing $5 billion.
Yeah. And to me, by the way, that's an extraordinarily complicated business. But today with AI, you could get it done way faster. But if you like sat down and had like a handful of people just grinding that problem out, you would get that problem solved. And you actually would tell them, you should be able to give them an over and under meter every day on how much cash is flowing in and out and where it's coming from. I don't think I think that's totally possible. You just need to like have people who are going to just keep grinding until they like figure it all out. But that's like at the giant end extreme. But I'm just talking in like normal, everyday kind of businesses that are running
Yeah.
the economy. What's your weekly cash in and out? And do you understand when you need to push a payment out? And do you understand when you need to make some phone calls to bring some cash in? Right. You gotta know that
Yeah.
and know what levers you're going to pull when. Um, I would say the next metric I would also look at is how big does your pipeline need to be in order to generate the next sale. So a lot of it is like the front end revenue
Sure.
generation, and then not as much on the ex, uh, the expense management side. It's more cash in and out. Yeah, and I would say it was those four things are like kind of what I would focus on. I think there's definitely like a whole conversation we can have about expenses, cost of sales, and all that stuff. But you wanted a few that are always top of mind for me. And
Always top of mind.
by the
Yeah.
way, when you figure out the true customer lifetime value, that also tells you a whole lot about your cost structure.
Right. Yeah. Good advice. Last question, because we're just about out of time. How did you define success earlier in life, and how do you define it today?
Earlier in life, I defined it as being in important conversations where key decisions were being made and success was being determined by those decisions.
So a seat at the
That's
table.
like,
A seat at the
yeah, seat
table,
at the
right?
table. Yeah, I want
Yeah.
to be one of the people at the table. Yeah.
Yeah.
And getting into venture capital and growth equity, that was a lot of that. I would say now,
Now you have your own table.
uh, now in my own table, I would say I define it more as, I would say in in a nutshell, it was captured by one of the CFOs on our team who had worked for a couple of other fractional outfits and said, what's so different about you and your firm from the other places that I worked is that we actually create work product that changes the way people do things. And I think that is kind of what I look at more where I am now is from a business standpoint. Are we kind of day in, day out doing things that are changing the way these people are guiding their businesses?
That's a good answer. For my audience who would like to get more information on Sal's company, if you're watching this on YouTube, right down here where it says see more, go down there and information will be there. If you're listening to this on your favorite podcast app, look at that podcast app's show notes and his company information will be there as well. We talked off air before we started recording about a webinar that he's coming up with. Unfortunately, that webinar is going to occur before this goes to air. But he did tell me, now we're going to make you do it because I'm saying it publicly, that he plans on producing some really good educational series of webinars. So when you're on his website, if that comes to fruition, I'm sure that information will be there and you'll be able to sign up and register for those educational webinars there.
Yes.
And he and I share the same philosophy in that those webinars are not designed to sell. There's no call to action. It really is more about educating, much like you've heard Sal talk about today. So I would highly encourage you as a business owner, if you are a business owner or if you're considering becoming a business owner, learn this financial stuff. Learn as much as you can. You may not ever get to a CFO level like Sal, but knowledge is power. And numbers, when they're accurate, tell a lot of truth. And sometimes it's an inconvenient truth, sometimes it's not. But you don't know where you are, you don't know where you're going, and you certainly don't know where you've been if the numbers aren't right. I can't stress that enough. I had many years of running my business where I didn't understand the numbers. They were scary. I purposely wore a blindfold, and I would get angry at people who told me my numbers were not good because I didn't want to hear that, even though they were right. So, so definitely, if you're ready to take your company to that next level, or if that next level requires more than a bookkeeper or a regular accountant, then consider getting side by side with a CFO, whether full time or fractionally. And I think that there's nothing better that you could do for your company than to get some good advice from people who have been there, who work with multiple types of industries, and who just know the numbers inside and out. So I would highly recommend that. Sal, anything you want to add before we say goodbye?
No, that was a great summary. I would say you could also find me on LinkedIn. Just, Google me. I have a lot of content that we put out on LinkedIn, and that's also a good place to figure out when our next webinar is going to be.
Excellent.
But
And I'll
we'd
have
love to
your
have
LinkedIn.
some new followers, and visit us for sure.
Yeah, and I'll have that LinkedIn profile in the show notes as well. So website, LinkedIn profile, all of that. So Sal, thanks for sharing the last hour or so with me. I really appreciate it. You're a wealth of information. I kind of wish I knew you way back then, but then it wouldn't have been the roller coaster ride that I've been enjoying all this time.
That you had.
Yes, but thank you so much.
Enjoy the journey.
It was. I'm a California boy, so as a child I used to go to Disneyland regularly, and back in the early days of Disneyland when I was a kid, like today you just pay one hugely expensive admission and you go on all the rides, included in that admission fee. Back then they sold a book of tickets, and there were A tickets, B tickets, C tickets, all the way up to E. And the A tickets were, from my young male perspective, were the dorky rides: Sleeping Beauty's Castle, Mr. Toad's Wild Ride, whatever, Jungle Cruise. And then the E tickets were the roller coasters. That may have been, I don't know if Space Mountain was open then, but Space Mountain, certainly the Matterhorn, those were E tickets. And the book would come with 20 tickets, but only like 3 of them were E. So my generation grew up with the phrase, "Oh man, this is an E ticket," meaning this is like a roller coaster. And working without financial knowledge is the ultimate E-ticket. It's probably a Z-ticket if there were such a thing. So we certainly had our E-ticket adventures. That. And I wouldn't do it any other way today because I had to learn, and I did learn, but I would have been infinitely cheaper hiring someone who already knew, because I learned at a great expense. And it would have been so much more cost effective had I just brought in someone to see that side of the business, because you learn one way or another. You either learn through making mistakes, which is effective, but not necessarily prudent. And there's a greater chance you don't come out the other end, successful at all. So definitely reach out to a professional like Sal, and they'll set you straight. You might not like what they have to hear, but it's it's a spoonful of castor oil sometimes, but it will save your life, your business life, your career life, your economic life. So Sal, thanks so much for your sage advice and sharing your journey with me. It's great to see you, and I wish you continued success.
Thank you. Thanks for having me. Really appreciate it.
My pleasure. And here's a final thought. Entrepreneurship is often framed around growth, more revenue, more customers, more opportunity. But as we discussed today, growth without clarity can create risk. If you don't understand what's happening beneath the surface of your business, growth can amplify problems just as quickly as it amplifies success. Sal brings a perspective that most entrepreneurs never get access to. He's seen companies from the outside as an investor, from the inside as a CFO, and now as an entrepreneur himself. And the common thread is actually simple. The numbers always tell a story. The question is whether you're paying attention to it. If there's one takeaway from this conversation, it's this. Don't just focus on growing your business. Make sure you actually understand it. The businesses that succeed long-term are not just the ones that grow. They're the ones that grow with control, discipline, and clarity. Now, that's a wrap. Thanks for being part of our Reluctant Entrepreneur family. We've been busy recording future episodes with fascinating guests, so be sure to subscribe to get notified when new episodes drop. If you're an entrepreneur or know someone who would make a great guest, we'd love to hear from you. Visit reluctantentrepreneur.podcast.com where you can apply or recommend a guest and just to learn more about the show. And a couple of shameless plugs. I've started a new series under the Reluctant Entrepreneur brand. The new series is called Reluctant Lessons, where businesses went wrong. On this series, we dig into high-profile business failures and the story behind it all. So far, we've profiled Rubbermaid, Kodak, Blockbuster, BlackBerry, and the DeLorean Motor Company. Check those and other episodes out on this channel. And if you're interested in my book, The Reluctant Entrepreneur, Anatomy of a Business Startup from Uncertainty to Unstoppable, it's available in paperback and Kindle on Amazon and as an audiobook on both Audible and Amazon. And to everyone listening or watching, if you find yourself stepping into entrepreneurship, whether by choice or by circumstance, remember this. Sometimes the path we never planned becomes the journey we were meant to take. Thanks so much for being here. I truly appreciate all of you. I'll see you again very soon.